Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 144. I tell you what, we take 1 week off from recording, and there is so much to talk about. We need to talk about the market dropping 1,000 points because of something that happened in Japan. I will break that down for you, the Japanese carry trade. And then we'll also discuss how the market has come back. What can the market do to continue this kind of recovery run that it's been on? And so we'll discuss your portfolio, some things you can do, some tips for saving more money, all of those great things wrapped up into one nice episode for you. So get your mind right and let's get to work.
You dropped this.
Welcome back to the show, everybody. Thanks for joining me again. Like I said in the intro, we missed 1 week of recording and so much has gone on in the market. It's just quite amazing. So a couple of weeks ago, actually August 5th, the Dow dropped 1,000 points in a day, which was the huge, was a huge news story for a number of days. And so the Friday before, Cameron and I had recorded that episode where we talked about and we discussed how the market was getting beat up. We were kind of going through a natural kind of pullback in the market, still trying to see if that's what it is or if the market's truly going to kind of go down. There's a lot of inflation data that we'll discuss in just a minute. And so that Monday, the Dow drops 1,000 points, huge drop for the Dow. And it all started like early in the morning where the stock futures were getting more negative and more negative and more negative. And it was all based on all this activity that was happening in Japan. And so one of the things that I know that I haven't talked enough about on this podcast is just how interconnected all the financial markets around the world are. And what happened that Monday is a perfect example of how interconnected all the financial markets are around the world, because there are investors all over the world who want to invest in American companies. There are American investors that want to invest in the investments of other firms that are not based in the United States. And so you have this interconnectivity of the financial markets. And so you might have heard that what happened that Monday was called the carry trade. So carry is in CARRY. So what ends up happening is as U.S. interest rates have gone up, Japanese rates have remained low. So there are some investors out there that borrow money in Japan and then they trade based on that money, or they'll put that money in U.S. Treasury bonds or whatever. And that spread that they have there is because they're able to borrow at, let's say, 2%, and the U.S. Treasury is at like 4.97. So there's a spread there where they can make that money if they were to do that. But most of the what caused this, they weren't doing that. They were borrowing money in Japan, and then they were leveraging that money. So they were borrowing on top of that money, and they were buying investments, investing in different companies. And so what happened was that the Bank of Japan raised interest rates. And when they raised interest rates, it caused all that money that was being borrowed to, number one, the fee, the expense of it went way up. And all of a sudden, with the markets being rocky and people being down on their investments, it caused them to have to unwind the leverage that they had on their portfolios was too much. All of a sudden, they start getting called out because they get a margin call. A margin call is where if you borrow money to invest and you start losing money on those investments, once you lose so much money, the bank will basically call that. They will give you a margin call. They will sell you out and they will take their money back, which means you are left with nothing and they are left with, the funds that they allowed you to borrow, or as much of them as possible. The more you leverage up your portfolio, the harder it is for, when stocks reverse, when they start to go down, the faster you lose money based on the more leverage you have. The interesting thing about this is, I talked about it when I had the last podcast, is I talked about reading that book, The Day the Bubble Burst in 1929, which was the amount of leverage that people had back then. And I'm still amazed, even though I've been in this business a long time, I am still amazed at how many investors are comfortable having a lot of leverage on their portfolio. And leverage is you're borrowing money to trade. And it's great when the markets are going up, but when the markets are not doing well, or they just go through a little bit of a rocky time, like we had like a normal pullback, like a normal 10% pullback that happens every once in a while, a very normal deal. But when you have a lot of investors that are leveraged, it's those trades start to unwind. And it's a domino effect. So I know we've talked about this a couple years ago, but it's a domino effect. So because I have to sell out, somebody else has to sell out, which triggers somebody else's trade. And the easiest example I can think of is it's like a zipper being unzipped, where one trade cascades all the others. And so even though we had a bad day, Japan had a really bad day. So on August 5th, Japanese stock market was down 12.5%. Which is the worst day for them since 1987, which is when the U.S. had a really bad day as well. And so it caused a lot of them, they're selling a lot of their investments. So because of that, when the U.S. market opened, a lot of investments were way down, and then we kind of fought our way back. And, over the past couple of weeks, over the last 10 days, the market has actually done a pretty good job. So we've had some economic data come out, which was CPI, PPI, the ones we've discussed many times. That data looks a little bit better, so we've had a little bit of a rise here. This week's going to be important. The Fed is going to be in Jackson Hole, Wyoming. They're going to talk about what they think about the economy, what they think about interest rates. Are they going to lower interest rates starting in September? The market thinks so. So right now, the market, there's almost 100% expectation that they will lower interest rates by 25 basis points. There are some experts that are saying it needs to be 50 basis points. And so the one key metric that I want you to keep in mind, the one key metric that is so important, is what is the unemployment rate what is the United States unemployment rate? So there's a really good website you can go to. It's the St. Louis Fed. So I'll type this in real quick. And the website, it's called FRED. So if you type in FRED, which FRED stands for Federal Reserve Economic Data, learn something new every day. So Federal Reserve Economic Data. So if you go fred.stlouisfed.org, you can look up all kinds of economic data. This is something I use in my economics classes that I teach. But if one of the ones is the unemployment rate. And so right now, the unemployment rate is 4.3%. So to give you a little bit of context on that, last year at this time, it was 3.5%. So that is a large move in a year. And that unemployment rate going up worries economists by thinking that there's going to be some type of a recession. And so recessions are quite painful, especially if you're an investor in stocks, because if people don't have jobs, they're not going to be able to consume things. They're not going to be able to spend money. And so because they can't spend money, obviously the future profits of a company are then, going to go down. And so their stocks will follow. So, watching that unemployment rate, it's one of the key metrics that I look at to see, like, is it a good time to pull back? Is it not a good time? Those kind of things. So looking at that number, we need to hover around here at this 4.3%. If the Fed lowers interest rates, that should help. But normally the worry is that the Fed waited too long to raise interest rates, and that they're going to wait too long to lower interest rates. And so that we will, maybe go into a recession. Maybe we will, maybe we won't. At some point there is going to be a recession. But one of the things that I wanted to see is how are other investors, how are hedge funds, how are big time money managers, what are their activities that they're doing? So they have to file something every quarter called a 13F, which tells what activity do they have. If you look at Apple stock, this one made news over the last couple of weeks because Warren Buffett sold about half of his Apple stake, and that really hit the stock hard. So it kind of all came together. So Buffett announced that he sold out, and the Japanese trade happened at the same time. So at that point, Apple went from 224 down to 204, and then it's all the way back right now. As I record this, it's at 226. So it went down, and then it's all the way recovered. But looking to see how do hedge funds, what changes are they making, all of those things. So one of the things that I used for this is I used Chat GPT. I used AI to help me start looking and going through all this data. So I was pretty excited about this. I've been thinking about it a lot. Is how can I use AI to, number one, help me be a better investor, help me comb through the data a little bit better, and how can I maybe be more efficient by using that. And so one of the things that I did is I went to ChatGPT and I started asking it like different things about different hedge funds. One of the things I asked is how much cash, which hedge funds have been raising their cash over the last quarter, the last 2 quarters. So I went there and I said, which hedge funds have raised their cash by more than 10%? It gives me a list of names: Bridgewater, Citadel. It's going through the big names, the big hedge funds. And so then I asked it, okay, well, which ones have raised their cash by more than 20%? And so then it's producing the names of those. And so I go through, I look at their investments. They haven't changed their investments too much, right? They're still invested in Apple, Amazon, the companies that we discuss. But what is interesting is the amount of cash that they are starting to slowly build up on the sidelines, and to have a little bit of, dry powder, so to speak, so that if the market does turn, with the election, with the Fed, all of these things, that when we have a bad day like August 5th, where the market drops substantially, they have money to then put to work. And it makes a huge difference, right? So Cameron and I talked about, on bad days, you got to buy something, you got to invest in something. So just like that Monday, and again, I'm going to say this over and over and over again because I just don't want people to forget it. And I tell my clients this all the time as well. Like I say this all the time. Most of the best days in the stock market happen within 2 weeks of the worst days. So the problem is it's okay. Like, it's one thing to know that, right? Okay, we know that. We got that down. But if you're fully invested on the really bad days and you don't have any cash to put to work, that isn't good either. So one of the things we got to do is we kind of got to balance that, right? So having a little bit of cash when there's a little bit more uncertainty, maybe we don't invest right away. Maybe we build up our cash pile a little bit. We know we have this fall. We know we have the election. We know it's not going to be smooth sailing all the way to the end. So if there are some companies that you really like, that you want to get into, there's an episode we talked about that we had called Trading Around a Position, where you trim a little bit, you raise a little cash, and it doesn't mean you want to be out of those companies, but you're waiting for a bad day to maybe put that back in. And that's a little bit different than I think than like timing the market. I'm not trying to time the market, but I am trying to take advantage of maybe some short-term volatility because of events that are going on around the world. And so just like in our example here, I talked about how, so Buffett announces that he sells Apple. Apple at the time was $224. You have the January 5th, Apple drops to, let's call it $204, $205. You buy a couple shares there, and then all of a sudden it's back up to $226. So, and you don't have to do it with a ton, but having, 5% of your portfolio, 10% of your portfolio into some cash will help you be able to kind of implement one of these strategies. So I think that is just kind of an important note to think about. But again, I keep thinking about and wondering about different ways of being able to use ChatGPT, not to give me any kind of investment picks or anything like that, but just to be able to go through data a little bit quicker. It was really neat. Like, normally there's websites you can go to where you can look at what kind of hedge fund activity is out there, what people are doing. But this, being able to ask it to look at that data for you, and it saves me. It's a ton of time, right? So normally I'd have to go through each one, see what their trades were, see what their cash position was. It's 3 different prompts. It takes about, 15 seconds. it probably saved me about an hour a time. So I think that's going to be really one of the keys for AI development in the future, and seeing how much productivity we can save. So looking ahead, I'll share with you different things that I find. And I know there's a lot of different prompts. There's all kinds of prompts that people can use for using AI. But again, the one thing, human behavior, I think, is still just a untapped area. It's not untapped. It's just that people forget about human behavior. So on that day when the market opened and how many people sold things that they shouldn't have sold, when you should be walking into the fire a little bit, it's just hard. It's just human nature. People do not like to lose money. Nobody likes to lose money. It's like the worst thing. It's just a horrible feeling. So we want that pain to be over. And on that day, like Japan, those were people who were selling because they had to, not because they wanted to, because the banks were closing out their positions. So you have to remember that too. When there's a really bad day in the market, I think about who's having to sell, and they don't want to. And I should just add right here, this is another reason that I do not use leverage on any accounts that I manage, my personal account. I just don't use leverage. And it's not that I understand why it's good. I'm not trying to bash it. I'm trying to tell you that it's not my personality. I don't know how investors who use a lot of leverage are able to sleep at night and not worrying about it. It's just not me. So again, a lot of this, when it comes to managing your money, when it comes to setting up your investments, when it comes to setting up your finances, you got to know yourself, and you got to know the things that you're comfortable with and the things that you're not comfortable with. I like not using leverage because if I invest in a company and it doesn't do well, I can just keep holding it. And, a couple of days later, it could come back, right? So, if you didn't have to sell out that Monday and you were able just to hold on to those investments that you had, a couple of days later, you were doing much better. Actually, it didn't even take a couple of days later. It was, from 8:30 in the morning, and then at 2 p.m., you were doing better. So as long as you didn't have to sell, you were doing much better. So this could be a good time thinking about different ways for you to save money and add to your portfolios a little bit at a time. This could be when you have this kind of volatility where the market isn't going straight up. You can use these little bits of volatility to kind of add to some positions that maybe you've been wanting to add to that have been doing really well. And you can buy 1 share, 2 shares, 5 shares, whatever it is, and just kind of improve your positions. And so, and if you bought some shares, you feel like they were too high, maybe if your stock gets back up on a 3-day run, you can trim the high shares, and then if it drops back down, you can buy those shares back. So all of these little bitty things can kind of help improve your positions, improve your cost basis, all of those things. Now, I will say one more thing about the Japan carry trade is that I saw an article that talked about Warren Buffett and how he invested in the Japan carry trade the right way. And what he did is he invested in some Japanese investment firms, 4 of them. And I remember this being discussed when we were in Omaha, that he invested in these Japanese trading houses. And I mean, it's just kind of ridiculous. So I guess he thought about or was informed or whatever about that Japanese carry trade, U.S. interest rates up, Japanese interest rates down. He and his team figured that there would be a surge of activity in those Japanese investment houses. So he takes a position in all those, ends up being the winner of all winner. It's just kind of ridiculous. It's just absolutely insanity how good somebody could be at this. So, but Warren Buffett has increased his cash position. A lot of investment firms, a lot of hedge funds, a lot of investors have increased their cash position. So having a little bit of a cash in your account, it is very important to do so because of times like this when there is volatility, for you to be able to put that money to work on the bad days. So the bad days, instead of being worried about them, think about how you can use those bad days to increase your better position your portfolio, add to your portfolio. But again, you got to have some cash in that account to be able to do so. So look for some some ways that you can increase cash. Maybe if you need to trim some positions, you've had some positions that have done well, you can trim them a little bit, put some more cash in your portfolio, do those kind of things, and that should help improve your overall portfolio over time. So I hope this has been helpful. And as always, don't mistake activity for achievement, and I'll see you next time. Thanks, everybody.